Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we are going to have a double feature. I had a request for AutoZone stock and I'm going to add O'Reilly Automotive because they're very similar and it's worth kind of taking a look at both of those and comparing them together. As always, this is not individual investing advice. This is just how I analyze stocks. If you have a request, put it down in the comments. I'll get the ticker on the whiteboard behind me, and eventually I'll make a video for you. And I'll let you know once I get it up on the board. I'll reply to your comment. Okay, so we're going to use a time until payback analysis for these two. What we do there is try to see how much time it would take to earn your money back if you bought the whole business. So if you paid $100 for O'Reilly or Automotive, how long would it take to make $100 in earnings from this stock, given how much you pay for the company's earnings and how much they grow over time, like the initial valuation or the initial kind of earnings yield, and then how much it's expected to grow over time. How long would it take to earn your investment back? So I call this the time until payback valuation analysis. I'm going to do it for both of them and kind of talk about some broader themes, maybe a little bit along the way. I am long AutoZone stock. Maybe we'll start with them. And I bought it, and I have made one video on it before, but I don't think I use this style of analysis. I use my other style of analysis where I look at a 10-year CAGR expectation from the earnings instead of how long it would take to earn your monies back. So a little bit different than the one I did last summer, but if you want to check that one out, you can too. So I bought AutoZone stock in the Cyclical Investors Club right at the bottom of the March 2020 downturn, which has been really nice because, and I still own it, and I've basically just held it because it's up about 370%. So that's been great. Now, the flip side of that, sometimes getting things right at the bottom, is I was also watching Oreilly at the same time. And I remember very clearly it was the next stock on my spreadsheet that was about ready to hit the buy price, just a couple cents away basically from hitting it, and it did not hit. So one hit and one didn't, and so I missed Oreilly completely, which is done just as good as AutoZone, but I did get AutoZone, and that's just how it goes. You know, sometimes when you have a method that you're using, that you try to have a repeatable method, that you stay disciplined, and sometimes it gets like perfect timing, and then some, or perfect I mean, in this case, it kind of really was timing because it was just a matter of, pennies on whether I bought it or not. And sometimes you miss out. So I made some adjustments since then. I layer in a little bit earlier and with smaller amounts than I did back then, just so I am more likely to catch those O'Reillys and not miss them entirely, at least have like a partial position. So a little portfolio strategy to think about there. So we're going to look at the fast graph here. I do have a 25% off affiliate link down in the description for fast graphs. I've been using it for years, and it's really useful for stocks like this, especially when they have nice and steady earnings. So when we look at earnings per share over time, it's basically perfect, right? You couldn't ask for anything better than this for AutoZone. Let's look at Oreilly 2. Let's see. There we go. And we'll see something very similar. Again, these are very similar stocks, both in the auto parts business. If you're not, I assume most people have seen their stores around there everywhere, pretty much. Since I own AutoZone stock, I usually do business with them. Just got a battery replaced a couple weeks ago. Pretty good for retail. I don't know if I owned a garage, I probably might not use AutoZone as much, but if you do any of your own work on your cars, it's pretty good place to do business with. So again, all pretty similar, and earnings look great. Basically no cyclicality. Now, the catch here that you need to be careful of is if you look at, let's shorten this fast graph. So the fast graph will calculate from whatever time you set this little time bar to, and I think you can even get more detailed and type in the dates now, where it says choose dates here. since I'm kind of old school, I've been doing this so long, it takes me a while to sometimes catch on to all the new features, because I'm just busy kind of doing what I do. But this will measure point to point and looking forward a year on what the earnings growth has been. So if you look at O'Reilly during this 10-year time period, earnings growth has grown at 17% CAGR. So that's really good. Let's also look at AutoZone. And then I'm going to show you guys why I don't consider it really that fast. So now usually when I say things like that, it's because earnings have gone up and down. They've had some cyclicality to the earnings, so you aren't really collecting those earnings if you own the business at that rate during the whole time. Some years are lower, some years are higher. That's not the case with these guys. Again, we have a 15.5% CAGR over this time for earnings. The reason their earnings growth is so good, and to some degree why it's been so perfect over the years, is because you'll notice that neither one of these businesses, I know AutoZone does it, and I'm pretty sure Oreilly doesn't, but let me check here just to make sure. Yeah. So neither one of them pay a dividend. Yeah. See, dividend yield 0. So basically what they do is, instead of paying a dividend, they buy back stock with whatever they have left over with their earnings each year. And over time, that adds up. So that's good as long as the real earnings keep growing. And for these guys, real earnings have grown during this time. But you need to be really careful when you're calculating an earnings and earnings growth based valuation, because if you owned the business and you kept those earnings and went and bought, like a boat or something, well, you can't then use those earnings to buy back shares too. So it's just like the dividend. The dividends come out of earnings, so I don't add dividends to the earnings like some people do, which is a major mistake, I think, because the earnings or the dividends come from the earnings. So if you're the owner, if you view yourself as I do when I'm doing these type of analysis as the owner of the business, if you take money from your business in earnings and you pay yourself a dividend from it, which is actually kind of what I'm assuming here when I do this type of analysis, that you take all the earnings and use them as a dividend for yourself, then that money's gone. Like, you don't get another dividend on top of it, right? So you want to keep an eye out for dividend investors, especially who are adding dividends to the earnings growth. So you don't get earnings and dividends. you get earnings and the dividends come out of them. Well, buybacks are exactly the same. So what was I looking at not too long ago? Nike, where I was talking about how they bought back shares and now the stock price is much lower, and they paid too much for those buybacks. Well, in this case, earnings, even if I took out the buybacks, would keep growing, and the stock prices kept going up. So these buybacks that Oreilly and AutoZone have been doing have actually been really good. But investors are not getting a dividend, right? So you have to kind of do and figure out what is best. Now, my personal view is, once a business earnings growth starts slowing, let's say if it gets below 10% or so, personally, I think starting a dividend makes more sense at that point. Because businesses have life cycles, and eventually, they die or they stop growing, right? And at that point, they should return, instead of buying more of their business, of their old no growth business or low growth business, returning those earnings to investors makes sense. So the investors can go out and buy something that does have growth with the earnings. Like, they don't need to sell it. There's plenty of no growth businesses that if they earn enough money, for the owners of them, they do just fine. Now, usually public stocks trade at very high valuations. So, the math doesn't work nowadays as good, but I mean, there were days where you could get like a 10% dividend or something from a stock. It didn't have much growth, but you're earning 10% of your money, that's okay. You can do that for a long time and get a good return if the earnings are steady, at least, right? I don't usually buy stock businesses like that nowadays because the market just charges too much for everything. If I'm going to pay a lot, I want growth to come, right? So to justify paying a high PE ratio. All right, so where was I? I was back on okay. So we're going to look at how much of the company they bought back in the past 10 years. This is O'Reilly. They have reduced their share count by over 43%. So really almost they're closing in on buying half the company over this time period back. So that's good if the company's still growing. Your portion, if you owned the stock 10 years ago, has now doubled almost, really, because they've bought back all those shares. So AutoZone is even more. AutoZone's bought back really nearly 50% of the company over this time period. And your share of the business grows as they buy and retire these shares. As long as the business keeps growing, that's great. If the business slows and dies, then that's not good because you own more of the business. You don't have the cash that you could have gotten from the dividend potentially. So you have to, so for me, it's like the earnings growth rate really is what should determine like the dividend, like the amount of earnings that go to the dividend. But these guys have both been growing well. So as we saw, the basic numbers were what, 17% and 15%. Well, when I back out all those buybacks, the earnings growth is lower than that, but still good. So basically it's 10%. And these are rough calculations. It gets a little tricky when they buy back so many shares, and you never know exactly what they are paying for each share. So I don't try to do like specific math on it. I just try to take it into account, right? So AutoZone's growth rate, I assume, has been about 5% less than it looks like on earnings per share, because when they reduce the share count, it makes the earnings per share growth higher because there's fewer shares. And then what was Oreilly? 17%, and I have closer to 11, right? For earnings growth. That's still really good. That's still not low enough where I would be like, hey man, why aren't you guys paying me a dividend? Now, if this growth was like 5% and they weren't paying a dividend, to me, that's kind of a capital misallocation. They shouldn't have been buying back a bunch of shares of their slow growing business. They should be giving that money back to shareholders. Just my personal opinion. Other people, some of them smarter than me, have a different opinion, but that's how I view it. And I don't get too wound up over it unless it's like really egregious, right? All right. So we can do the math now. What we want to know is how long it would take to earn your money back from their earnings if their earnings grow about 10% each going forward. The actual numbers are right there that I'm using. So I take also into account the debt that they have. So I think I boosted, for the purposes of valuation, AutoZone's price by 22% and O'Reilly's by 11%. In order to come up with those numbers, I look at the difference between the market cap and the total enterprise value. So you can see basically what I'm doing is I'm using the total enterprise value for the valuation and just adjusting the stock prices accordingly. Okay. That gives us a 3% earnings yield for O'Reilly and a 3.6% earnings yield for AutoZone. So if you paid $100 for these businesses, with AutoZone, you'd earn a $3.63 on your $100 the first year without earnings growth. And O'Reilly, you would earn $3.02 without earnings growth. But both those earnings are growing like 10, 11% a year. So what I try to do is see how, if we include that growth, how long it would take us to earn our money back. So I'll just do AutoZone here. So that $3.63 with the growth would be $3.99 the first year. So I assume you could just keep that money. And then the next year you'd earn $4.39 and you would keep that. And then how long does it take you to get to $100? And that's when you've earned your investment back. So drum roll. AutoZone, it would take about 14 years, and O'Reilly about 15 years to earn your money back if you bought them at today's prices. That seems right in line with like the S&P 500. So these look like they're valued just the same as the S&P 500, which is actually pretty expensive. But if you were going to sell one of them and just go buy the index or buy just a kind of a random stock in the S&P 500, probably whatever you buy isn't going to be any cheaper than what these guys are. So if you're somebody like me and you're holding AutoZone, I'm just going to keep on holding it, and hopefully, maybe the price will fall quite a bit at some point. But the basic stuff's there. I bought it cheap, and there's not anything else that looks like a lot better, right? Same, I would say, for Oreilly, even though Oreilly is a little bit more expensive on my calculations. They're both pretty close to the same. So I guess the question would be when to buy them. I didn't do that ahead of time, but I know it's going to be about 50% lower than where they trade right now. So I'll just try 1,500. We want to get that down to like 10 years. Oh, that's not quite as far off as I thought. So AutoZone, and maybe 1,900. Let's see here. Oh, maybe. Oh, my spreadsheet froze up. Yeah, so in between 1,800 and 1,900 for AutoZone would be the buy. It's trading at, let's see. I'll give that a chance to load. And then sometimes they like to load and sometimes they don't. But that's kind of where the buy zone would be for that. Under 1,900. Oreilly, I'm going to guess, is going to be maybe like 650-ish. Yeah. Maybe you can pay a little more. Let's see here. We haven't got it up to 11 yet, so. Is this thing working? There we go. So under $740 a share for Oreilly would be what you would be looking for. Let's see where it was. I think that is going to be about 50% lower, maybe a little less than that, 40% lower. That would give you like a margin of safety. That's kind of what I was paying back in 2020. It wouldn't necessarily be fair value. It would be margin of safety, trying to get good returns. Has a reasonable chance of happening, but you're probably going to need some kind of bad news or recession or scare. Or there was a time back in, when was it? This is before I owned either one of these. Right here. I remember it, 2017. Let me make sure it wasn't back farther than that. I think that's the right one. Yeah. Okay, so often people will be like, hey, those prices will never happen. Well, I own one of them, so they do happen. And this is a good example at a 15 PE. Where's it trading now? 30, so half off, right? Look at their earnings. Nothing happened. Do you want to know what happened? Amazon announced that they were getting in the auto parts business. So the market freaked out, thought that these companies were toast, and sold them off. And that's how the opportunities happen. And, everybody has forgotten about that except for me, maybe. And if you would have bought then, again, not a recession, nothing crazy happening, just news, just traders being traders, and you would have been up 657% if you would have bought back then. You just got to track all of them. I mean, that's what I do in the Cyclical Investors Club. I also have a weekly pick service over on Patreon for $25 a month if you want to check that out. So for those of you folks who think I never buy anything, I force myself to buy something every single week, and share the idea on there, whatever the best thing that I can find is. And those links will be down in the description. If you found this video useful, hit the like and subscribe buttons, and I'll see everybody later.